Hi, everyone, and welcome to the TradeFocus video series. This is the Mission Million Money Management video number 4 in the Mission Million series. And today, what I'm going to be doing is I'm going to be talking about the risks associated with applying money management. So, yes, there are additional risks and certain types of risks that are associated with applying money management strategy, but I'm also going to be talking about the risks associated with not applying money management or proper money management strategies to your trading. And generally, there is very little additional initial risk associated with applying proper money management strategies to any given strategy. So there are, in some cases, in some circumstances, additional risks from the beginning by applying proper money management strategy, but not always. And proper money management requires that you start off with a minimum trade size, right? So that's built within the money management approach is to start off with the right trade size, which, by the way, is the same and often lower than what the initial trade size would be if proper money management was not applied. Many times I've talked to traders who have started off with a far bigger trade size than they ever should start off trading based on their account size and based on what they think they should be risking in order to make what they want to make within the account. And when you interject the proper money management approach to it, then that automatically lowers that initial trade size a lot of times. And so, no matter what, if the minimum trade size is taken in both scenarios, then that obviously there's no additional risk at the beginning. However, there are circumstances where even if you start with a minimum risk in both scenarios, that there is a little bit additional risk or a small additional risk associated in those certain circumstances when applying money management that are not there without money management. All right, so if you were to start off risking $10,000 with money management and risking $10,000 without money management, or let's say a $10,000 account, not necessarily risking the 10,000, but a $10,000 account, and with money management, you might be risking approximately 500 bucks, and without money management, you might be risking $450. It might be something along those lines. So it's really negligible, and it only occurs in certain circumstances. And so I want to briefly cover that. And again, this is all covered within the course itself, but I want to turn your focus on this so that it's something that is remembered from within the course because it does and can play a role in what you do and how you do it with regard to your trading plan. And as I talk about in the course, this additional risk is associated with asymmetrical leverage. And asymmetrical leverage is, again, just simply the inability to make up losses at the same rate that they occurred. Right? So a decreased ability to make up losses. That's what asymmetrical leverage is with regard to proper money management. And so let's take a look at some example increase decrease levels. Let's say that you have a delta of 200, and that means that on your first increase you need to have $200 in profits. And then on your second increase, so at $200 in profits, you go to trade size of 2. And then the second increase is at $600 in profits, and then you go to the trade size of 3. And at $1,200 in profits, you go to 4. 2,000, you go to 5, et cetera, et cetera. 3,000, you go to 6, right? So that's the increase rate. And as you well know, every strategy or every combination of strategies based on your risk tolerance levels and or profit goals are going to have a different increase decrease level. So this is just for an example in order to go through the process. Now in this scenario, let's say your max loss is 100 bucks and you have a delta of 200 because that max loss generally doesn't happen very often. And so you're going to be a little bit more aggressive with this scenario. So your max loss is 100 bucks, and let's say you reach $200 in profits, and your next trade is a $100 loss at 2 units for a total loss of $200. Now this drops you at 0 profits, right? So you increased to $200 in profits. So now in the next trade you go to 2 units. You suffer a $100 loss because you traded 2 units, that's $200 loss. Now you're back to 0, and you're back down to 1 unit. However, Had you not increased unit size, your loss would have only been $100. And so your total net gain at this point is at $100 with no money management. Whereas with money management, you're at zero, right? So in this scenario, in this type of or in set of circumstances, you actually are doing a little bit worse in this scenario. So if from that point on you never make another penny, the money management will have performed $100 worse than the non-money management. And it's only in this type of scenario where asymmetrical leverage occurs that this happens. All right, so now let's talk about the risk after money management. What are the risks when you've been applying the money management strategy for some time? And I know there's a lot of fear in traders when they see how fast they're increasing or how their trade size based on their profits is fairly large. And so, for example, if you start off with a 25,000, I've highlighted here in this example 44 lots, 44 units at $26,800. And I would never, ever, ever start off with that, right? But why would I be willing to trade 44 units with $26,800 in profits if I would never, ever start off with 44 units if I started off with $26,000 account? Well, the reason is because I don't have the proof. I don't have the experience, and I didn't build my account to that level, right? So that's why you don't start off this, but when you do build it to that, you have now gained experience, you've proven it, and the whole reason that it's at 44 units is because it's working, right? So completely different scenarios. Nonetheless, you have $26,800 in profits. You're trading 44 units. What are the risks in this scenario? And this is, by the way, the 1-2 super punch compounding table with a max loss of $35. So what happens when you go into a drawdown when you're down this table a ways and you're trading a much larger trade size with regard to the profits that have been accumulated in the account? Well, let's just go through this process. All right. So let's say that you build the profits to $26,800, and on your next trade, you go to 44 units or 44 lots. Well, if you suffer a $35 loss, which is the suggested max risk on these trades in normal market conditions, if you suffer a $35 loss with 44 lots, 44 units, that's a $1,540 loss, and that will drop your account to 25 to 60. Now, at that point, you're below the 26,800, right? The green shaded area. You're below the 26,800, so now you go back down to 40 units. And let's say you suffer the max loss at 40 units. That's 35 bucks times 40. That's $1,400 loss. And that brings you down to $23,860. And again, you're above the 40 unit level, which is 22,400. And so again, you trade 40 lots. And again, you suffer that loss. You're at 22,460. So now you're $60 above that level, and you still trade 40 lots on the next trade, which means that you lose another $1,400 if that's a loss, and you go down to $21,060, and then you go down to 36 units. Okay, and you just follow that, and I did this for 11 max losses in a row. And in the 1-2 super punch strategy, that will be very, very, very unlikely to occur in that manner. So with that in mind, after 11 max losses in a row, you drop from $26,800 down to $12,940 in profits. Okay, so again, those are profits that you're dropping. And some traders are like, wow, that is a lot of risk right there. That is huge risk. Well, I just gave 11 max losses in a row in a scenario where this is probably not going to happen. And if it does happen, it's not going to happen in this manner. It's going to take a lot longer time period to suffer that kind of drawdown. So it's an unusual drawdown for this strategy, for example. But you do drop from 26,800 down to 12,900. And that is a pretty big drop, and sometimes it's hard to fathom, risking that kind of money when it took you so long to build the profits. But you have to compare it to where you would be with no increases. With no increases before the drawdown, you would only be at $1,300 in profit. So no money management whatsoever. You'd only have $1,300 in profits before the drawdown. After the drawdown, after suffering 11 losses in a row, at the max loss, you'd go from $1,300 down to about $915. All right, so in other words, even though it's a big drawdown with the money management, you go from 26,800 down to 12,940, you are still $12,000 more than if you didn't use the money management in the first place. And that's what you have to look at. That's the benchmark. That's the comparison that you have to make in order to understand why you would be risking this kind of money. Because in order to get there, you don't risk very much more at the beginning, right? But you stand to make a whole lot more by following the money management table. And again, this is a highly unlikely drawdown in this scenario. So with 11 losses in a row, you would drop from $26,800 down to $12,940, or about 51% of your total net profits. But what I want to show you here is that in essence, at 11 max losses in a row, you would drop no more than 4 levels. And that's something that you can begin to use in your money management assessment. When you're looking at your money management table, you can always figure out how many levels you should drop based on the drawdown size, and that's going to remain constant throughout the entire money management table. So if you drop four levels, let's say you go to 12 units, and you suffer that drawdown that I just gave you, 11 losses in a row, max loss of $35 per trade, you would drop 4 levels. So you go down to 8, you go down to 4, you go down to 3, you go down to 2. All right? That's where you would be. If you did that at 52, you would go down to 48, 44, 40, and 36. And no matter where you are, that's where you drop. You go down 4 levels. All right, so at 84, if you get up to 84 units and you're at $92,800 in profits and you go into that drawdown, it drops 4 levels, 80, 76, 72, and then to 68. And that lets you know where you'll be at after that size of a drawdown. It's 92,000 down to 61,000. It's $30,000. All right, so it's a big drop, but it's 34% of your profits, which is less than the scenario that I gave earlier, where we use the example of the drawdown occurring at the 44 lot area, right? You gave up about 51% of your profits, but in this scenario, it's only 34% of your profits. So the farther you go, the less on a percentage wise that 4 level drop is going to represent. But without compounding, you would only be at $2,300 in profits before the drawdown. So instead of $2,300 in profits when the drawdown occurs, you're at $92,800 when the drawdown occurs. That's huge. And then after the drawdown occurs, you're still at $61,600. So that is, if you do not use money management, that is a lost opportunity risk of $59,300. That's a lost opportunity risk. That's a risk. So if you don't use money management, you're risking, in this scenario, $59,000 in profits that would have been there had you used the money management. That's a huge risk, and that's the way you have to look at it, so that you force yourself to think properly about how money management should be viewed within your trading. So the question is, are you willing to risk $59,000 to make $2,300? Because that's what you're doing if you do not use money management. This is why, and the whole purpose of this is to help traders understand, again, right expectations so that they can make right decisions, and it's to help motivate you to stick with the money management. Stick with the money management. It is well worth it. A lot of times traders begin to taste a little bit of success and all of a sudden their risk level goes out the window. They don't want to risk anything. They drop their contracts. They don't increase their contract size or their unit size. They slow it down. Um, the only time you should ever slow it down is if you plan to slow it down, so you pre-planned it out, and or you realize that you are too aggressive with the money management in the beginning. And that's when you should slow it down. If you slow it down because of fear, you got to understand what you're risking. And it's in this example, it'd be $59,000 of lost opportunity risk. All right, so stick with it. Obviously, make sure that you have the right plan in place, which is what will help you do, but allow the money management to work. You're not going to be any worse off by allowing the money management to work. All right. All right. Hope you enjoyed this video.